All right, hi everyone. Thank you so much for joining me. This is the March 2021 Life Design Analysis webinar, and I am your host, Charlie Conron. I'm also the CTO and founder of Life Design Analysis. Now, this month I think we have a great webinar, although I say that every month to you. But this month we're focusing all around insurance concepts. And, it's hard to believe we're already in March, but the weather is starting to turn nice. We're through RRSP season, and, we're kind of right in the heart of tax season, which really is a good transition to set up a lot of those life insurance opportunities, especially when talking with your clients, when even perhaps if you're preparing their taxes or they've just gotten their tax return. Again, we've got some great strategies that we're going to show you today that are going to make some of these concepts that much easier to present to your clients. And a lot of times, we do a great job of presenting the numbers, but we need a little bit of that concept information to really help hit that home run and connect that idea of how the insurance is going to work with some of the values behind it. So we're going to focus a lot on that today. Before I get started, though, I just want to do a couple housekeeping and updates. Just to let you know, this webinar will be recorded, so we do get that a lot in the questions section. Yes, you will be able to find a recording on our YouTube channel, but also on our blog here. So if you navigate to lifedesignanalysis.com, check out the blog section. Lots of information on different articles, even on presenting concepts. Some really great templates on there and concepts. But if you wanted to find a recording past the webinar, you can find it, as well as all of our past recordings. If you wanted to try out any of these concepts that you do see today, remember you can always try out our 30-day free trial. There's no credit card on sign up. Lots of different packages available, but you will get the best one. Remember, should you be watching this and wanting to activate your account, you can do that as well through that subscription manage edit. Just remember that LifeGuide subscribers do get an exclusive discount to LDA software, so get in touch with us if you are a LifeGuide subscriber. But again, lots of functionality in there for everyone. Now, I'm going to go ahead and log into my account. Again, remember, Life Design Analysis is all web-based, so these concepts are something that you can create on one device and actually present on a tablet, or I'll even show some case sharing later. But without further ado, let's get started with our first concept. All right, now when starting any sort of concept, obviously we're going to start with a new case on a client. And for me, I'm going to use Phil Mickelson, my kind of test client for this first sort of concept. Remember, this works for different clients inside the system, but it really all starts with adding a certain product that we're going to run the concept off of. So you can see Phil here is a 41-year-old male non-smoker. I'm actually just going to override Phil's age to age 40 just to keep it simple here. And I'm going to start off by actually adding a whole life plan, because the first concept I want to focus on is sort of that corporate asset transfer or personal asset transfer. And I think this is a particularly good time with the market at sort of all-times high. There's a little bit of instability, and potentially clients are doing taxes and seeing a big taxable gain if they've sold any of those investments, or perhaps they're just looking to shift their portfolio to something a little bit safer. A lot of times the corporate asset transfer is looking at that safe money portion of the client's portfolio and sort of shifting it from column A, which is highly taxed, to column B, which is going to be a lot more tax efficient, using the life insurance and leveraging it that way. So again, this is something that's going to work across any of the different whole lives that you choose. The nice thing about our concepts is they are carrier agnostic. So really, you're going to bring in the data from whichever whole life plan, or overfunded UL, or even some of these min-funded ULs, permanent plans, when we get into things like charitable giving concepts and things like that later. I'm going to start off with just an equitable life whole life here to run my first concept, and I'm going to go ahead and basically design a plan and import the spreadsheet, because I want all of the advanced values, things like the adjusted cost base and things like that. Now, I'm going to focus on a $20 million. If you were doing this for, you can obviously add accelerator like ADO deposits in there. So again, I might do, sort of a max deposit, where you can see here my minimum payment is $27,000, but my total deposit is $46,000. Now, all I'm going to do is view the spreadsheet. I know this is a little bit small. I'll try and zoom up here. I'm going to export this to Excel. Again, it gives me the warning message. That's okay. And basically from Excel, all I have to do is either copy and paste the whole spreadsheet. So you can see I've just clicked the top left to select all. Again, alternatively, you could save that whole thing. I kind of prefer the copy and paste, because again, I just simply copy it, and then I'm going to come across to LDA, where I'm going to paste that in. Don't worry about kind of the jumbled uploads. If you're looking at this for the first time, there are instruction videos on each different plan, where again, we'll show you how to bring that information in there. And I'll just show you just sort of baseline. If I just generate my report, we can just take a look at sort of without the concept in there, how we would present this. We've got our 20-year deposit, we've got our cash values, growing in there, and we've got our whole life. Now, as I said at the beginning, a lot of the times we do a really nice job at showing the numbers, but actually transitioning the concept and showing them how the mechanics of this would work are a little different. So you notice if I go back to the case design here, I can go down a little bit, and there are some areas for report concepts. Now, one of them is the corporate asset transfer, one of them is the personal asset transfer, and you can see there are some other ones, like even by term invested difference would be a great concept that you could put in there. Anything at all, really, we can add in there as a concept, and these were traditionally text notes that went along with there, as well as certain report components. So for some of our concepts, we can just simply select corporate estate concept and go down, and you'll see that things like the report note have automatically been added. Again, I can toggle things if I'm doing corporate or personal, and you can even see I can, with the asset transfer, I can control some of my assumptions. So I notice a lot of people are doing to age 95 as their target age, with people living longer, and I see it's very popular to do 100% interest with a specific growth, and thinking about the kind of assets that whether your corporate clients are holding on the company balance sheet in column A. Based on the diversity of assets they have, that's where you would kind of mix up the different investment mixes. But in the in the interest of time, I'll put 100% interest and go 5%. Now you can see you can put sort of controls for each of these different asset classes, so you really can have a diverse mix. There's also kind of an asset premix if you wanted to kind of mix that 100% up across the different asset classes. I'm going to leave mine simple here, but just remember you can kind of modify these if you wanted to kind of change it down to a blended rate. You could lower the tax rates as well, or kind of adjust this as you see fit. But it really is easy to get the concept in there, just simply using this drop down at the top for concepts. And going down, you'll notice that of the report components, you can see a lot of my default components have been unselected. Things like the total cash value page or the insurance benefit page, because we want to run sort of advanced calculations on the personal strategy. So in this case, we're not so concerned about the total insurance benefit, because if this is a corporate asset transfer, that insurance benefit is going to be paid through the CDA and extracted that way, the capital dividend account. And so there is a little bit of a calculation that goes on there. So we want to use these asset transfer strategies. So I've got personal asset transfer. We've got our nice little graphic for the concept. And again, we can choose, kind of our potential capital or rates of return. I've got kind of potential rates of return there. But again, you could change that to capital depending on, sort of your preference for if you want to think about in terms of rates of return or you want to think about dollars. So you really can structure this however you'd like, but very simply, again, I load in my whole life plan, I select my concept, and I can really quickly, regardless of carrier, generate a concept for that client. Now you'll see with the concept, what I'm trying to illustrate is really the flow of money. So, we have our kind of text on the operations of how this actually works. We've sort of got our plan details in here, meaning, what kind of plan are we trying to satisfy this asset transfer with? And then we've got any of those assumptions that we plugged in here. So things like our target age, I set mine to 100% interest growing at 5%. So as you adjust those kind of things, you'll see those are all printed in sort of our assumptions page there. But really, the concept, when I talk about, we do a really great job of doing the numbers, but sometimes we need, that flow of the overall approach. And so we've got kind of a graphic here that shows basically that traditional approach of, you might be holding an investment that's getting taxed on income and would get taxed again. And it's really that double taxation that creates the efficiency in our proposed strategy. Again, people really like, kind of the traditional approach because their money is very visible. Kind of the idea is that it's very accessible to get in the traditional method. But again, when we pass and we liquidate that investment, we get the tax deferred on gains and tax on the estate. Whereas the proposed strategy, again, we would buy, the investment would go into an insurance policy. So we'd shift it from account A, which would be the traditional approach, into account B, which is the investment approach. And again, that funds the policy, which, as we know, the cash-free growth or the paid-up additions can grow tax-free. There's no tax on death. And really, I think the misconception maybe sometimes in this strategy is how we access the cash value. How liquid is this strategy? Again, there's a couple different ways that we can access that cash value: collateral loan, policy loan, or just a policy withdrawal. And what we see out in the market is that the kind of a policy loan, collateralizing the insurance policy, is a very effective way to do it, because once that value is in the policy, again, it's not like a stock where it can be at GME all-time highs and all of a sudden the next day it's completely low. Once the cash value is in the life insurance policy, it's completely locked in there. And again, on death, we get it paid tax-free. Divot CDA credit goes in there. There is, a small portion which is going to be taxable. So when we look at this strategy, when we actually look at the numbers, it's not necessarily, as I said, that total insurance benefit. There is a calculation that runs on that refunds you a little bit of that ACB that you'd pay some tax on that as well. So in some cases it'll be a little bit higher, but it won't be the total insurance benefit. Great chart here, just kind of looking at, again, A versus B. And these are a little different from our pure numbers. We're looking at, sort of how in that taxable investment, sure, you grow the whole pie quite large, and it does grow quite big, even bigger than our net estate would be on the insurance side. However, the flaw of it is that no matter how we grow this big piece of the pie or the whole pie, the slice we're left with after tax is significantly smaller than what we'd be left with the insurance benefit. Again, when we look at potential capital required, because we're losing so much in tax, we are required to make that much more to get kind of the similar benefit. And you can see you can also do reduced examples as well, just like you would in our regular charts, where, again, even if the policy here doesn't perform as we think it's going to and achieve that great total benefit, maybe we achieve a lesser net estate benefit through the insurance. That will mean we'll require less potential capital to match it. But all in all, what we're looking for is that we want the most efficient solution possible. And so, we want to look at how that life insurance, sort of plays out versus those other asset classes. Again, we have a really nice flow of how this money works. So this is kind of that number side of the concept. But what I think is really good about having sort of a graphic like this is that we're not talking numbers. We're talking high-level conceptual, the mechanics of the operation. And then once we see the benefit of that, now we can start to see how some of these numbers play out and start to understand them a little bit better. That, sure, we could take this, let's say the annual cash flow on the balance sheet. In this case, maybe it's a roughly $50,000 deposit for 20 years. And we can say, if we were to invest $46,000 and earn 5% growth on that, we would get roughly $2,302 per year. But as we said in the kind of the overall graphic, the flaw with that is that we're going to be taxed on that growth. And so because of in this case, our 53% tax rate, we're actually, even though that 46 nets and earns some money, we actually don't get to keep all of it. And of course, we pay the government $1,500 or $1,155 of that. So again, basically brings that end of year balance sheet number of the corporation in this case to 47. So we certainly gained, it's basically the 46,040 plus, again, the difference between the annual growth and how much we give back on tax. And then, of course, there is a returnable dividend tax on hand credit, so that kind of comes back to us, and you can see that number boosts itself a little bit. But at the end, if we're to get taxed on our whole estate value and liquidate that, again, that's where the big kind of detraction is. And these categories, I would say here at the end, the net estate benefit of your taxable investments here in red versus sort of that same column, your net estate of tax of the insurance, is really that key component. You can see, of course, immediately we pay that first year premium and we have a really large insurance benefit. Our strategy is going to have a really significant boost to it. Now, as that alternate investment starts to accumulate, again, it grows over time. What we're really looking for is that our strategy has some kind of advantage. And again, this one may be a little bit unfair here. You can see I've given it a big advantage, and some of you might say, well, Charlie, 100% interest, what if you kind of change those assumptions or, kind of made them a little bit more balanced? So I'll just say I'll split the growth and say 10, 10, 40, 40, and again I can regenerate the report here. So feel free to configure it for the alternate investment component of it itself. This is really where all those controls are driven from. You can kind of customize that to your own risk tolerance or your own kind of market conditions, but that's really going to impact the underlying numbers. It's not going to change the approach or the concept itself, but it will kind of change those numbers. So you can see when I move it to more of a balanced strategy, we're not as efficient, and in terms of even at the end, we're actually less efficient. So depending on how you kind of structure that strategy or how your clients' alternate investment strategies can go, they may not have unrealized capital gains that as 40% of their sort of that portfolio that they can put that in. So really great way to kind of create those kind of concepts. And again, when we look at sort of that alternate investment, a lot of the numbers in LDA are going to be driven from this sort of alternate investment module here, where we can kind of simulate those different sort of scenarios. So again, if I put 10, we've got 30 there. Let's do 20 here. We've got 30, 40, and then I'll just make this, I'll make this 60. So again, we might say that's a more realistic mix for our client, and go ahead and generate the report. And again, as I say, that's going to drive all of those different numbers. So play around with those within your own comfort zone, but that's a really great way to kind of create a concept and really cement those values in there. I'll just show you how some of those changes to that investment mix can really impact that concept here. And again, you can see if we don't have quite as much to put into unrealized capital gains, which again has a very low taxation rate, our strategy is going to be very attractive. Now, as I say, I can't really dictate what you guys put as the balance on there. That is totally within your realm as an advisor, but that's a great way that you can present that concept, which I find is a very, very large concept out there. If you wanted to dive deeper into that concept, we do have a more extensive YouTube video and a webinar focused exclusively on this concept. But for the sake of today's webinar, I want to get through a couple, so I'm going to move through these fairly quickly. But if you do have a question, remember to ask us on our live chat or reach out to your account manager. Now, another concept that's very similar to this, not in the sense where it's comparing an alternate investment to how the policy performs, but simply the mechanism of how we can take money out of the policy and use that as part of a retirement plan is the IRP concept. And you can see one of the things we've added as I go down in sort of my report components is this insured retirement plan. You'll actually see a couple of concept notes that we're going to go over, as many as we can today. But basically, these are the same idea of giving a high-level concept around a certain product to really back up the numbers in the report and how we'll actually utilize those. So you can see all I've done is just check off the IRP metric. And you can see as I go through, I'll have my regular report components. But now in there, we'll have a nice little concept piece around what an IRP is, how it works, and really the flow chart of just kind of describing the mechanics of this, so that when we do get to the numbers portion, again, we can talk about this cash value as the portion that we would leverage. Another kind of neat thing that you can do in LDA is utilize some of those cash overlays. So for an IRP, one of the things I really like to do, especially if you are doing a policy loan, would be, basically add in another Equitable Life whole life here. And while that's loading, I'm just going to come across here to our Illustrator. And this is where I can take things like policy loans or withdrawals out. Some are reflected better than others in the spreadsheet, but basically what I'm going to do is I'm going to say from age, and I'll just say 65, which is kind of where everyone thinks about retirement, to 85. I want to supplement my retirement with some of the kind of the cash values of my insurance policy. And with this one, I'm going to try a $50,000 withdrawal for those years and see if we can get away with that. Again, the software will kind of spit out if it's not something that's going to be achievable. But, basically we do our same thing. We design with the policy loan in there or policy withdrawal. And the same sort of process applies, where I will export the spreadsheet, I will select all the values, and I'll come back to LDA here, where I can simply paste those values in there and upload them. And again, just to keep yourself organized, you may want to sort of rename that policy in there. So you may want to hit the edit plan and say with policy loan. But again, I'll show you, and I'll just make sure I have my overlays on here. I'll go down here. One of the ways I like to do it is looking at these cash and insurance overlays, one just standard and one with that policy loan, and it gives us kind of a good visual of what we could withdraw for our insured retirement plan and how that would look. So again, we've got our concept note, we've got sort of the insurance, the assignment to the bank, we collateralize it and take that loan, and again, those proceeds, because it's a loan, are tax-free. And again, we've got our same plan in here. So I'd probably actually get rid of sum of premium and annual premium for this sort of concept, just because again they are the same funding. What we're doing when we try and overlay them is just basically show that here is the total, and when we look at that withdrawal, that's how much the cash values would be if we took out that policy loan in this case. So again, just illustrating the difference that there is still lots of value in that policy, but remembering that the reason it went down is because we're actually withdrawing those funds to supplement our retirement. So I think it's a great way to kind of show one over the top of the other. The exact same policy, the only difference here being that one is designed with the policy loan and one is not. And it gives us a really good visual when we use that overlay to show, again, we would pull out those values from the policy, so it shows the difference there. But again, those are going to go towards funding our retirement. And again, supplementing maybe those active years of retirement. So I think that's a really great strategy to use. And again, that same sort of graphic is going to be in there. I'll just go quickly back again here to the same case because one of the other ones, and again, let me just take away the second case. One of them was the IFA, and again, similar sort of strategy, the IRP or the corporate asset transfer. However, this would be, again, borrowing the money for the policy so that the other cash is freed up for the alternate investment. So again, not necessarily a one or the other, a both option. Now you'll see if you go down again to where we sort of were in those concept notes, again, we can select an IFA from the beginning here, and again, simply generate the report. Now, it's worth noting LDA is building a more robust IFA metric. They're quite complicated, though. There's many different ways that you can structure them. But again, really good concept in terms of, kind of describing what the concept is, how it works, and then how you might access the cash value. So again, similar to collateralizing it and assigning the bank the policy, but again, this frees up either that cash out of the policy to invest, or perhaps they maybe have borrowed the funds to pay the premium up front. Again, a highly leveraged scenario, but for certain business owners who certainly who want to reinvest in the business, this is a great concept for them. And again, you can then speak to some of the numbers behind the report and look at 90% of cash value and things like that of the policy. I'll also draw your attention to there is a collateral finance scenario where you can do kind of a rough calculation. Again, this is not perfect for every different whole life plan out there because there are so many different ways to structure them, but just to give you an idea of someone who might borrow the premium for the loan, what any sort of interest cost would be. You can actually customize that interest rate to see what an annual interest charge would be on kind of that policy. Again, remembering most people, if it's in a corporate scenario, are going to be able to deduct any of this interest. And again, there is also a deduction for NCPI or net cost of pure insurance that can be done. But remembering it's got some rules around it, so it is relative to the sum of the loan and that total insurance coverage that's out there. So you'll see, as that basically the adjusted cost base, sort of grinds down and the net cost of insurance goes up, there's more of a deduction that can be held. Although with a lot of these, again, the idea is that at sort of a particular age, if I take this client out to maybe 65, we see that, we paid essentially with the sum of the total loan as well as some of that interest that's on there, we've paid roughly $1 million, to finance the purchase of the whole life. However, the cash value in the policy is greater than that. And so again, we could wipe out and eliminate our loan with the proceeds of the cash value, and then any sort of surplus would go to the client. So a rudimentary start to it. We're going to get more advanced with our collateral finance and bring it out to more IFA metrics. But in terms of actually, having a graphic to kind of present the concept and some strategies around it, we find these visuals really help cement, kind of that idea around it. Again, if I go back to my case here, you can see, you can just simply check that off, and you'll look for collateral finances near the bottom there. For those of you who are looking, again, that financing rate that you would kind of specify would be found just at the bottom in the other controls. So again, maybe it's a more expensive financing rate at something like 8% if it was through like BDC or something like that. And again, that will kind of adjust those numbers accordingly. Although, because our calculator, assumes that we're going to write off a lot of that interest, again, it's still going to be attractive from a total cash value versus coverage amount. And again, remember I said, keep in mind that this is one way to structure it. This is not necessarily everyone. We also have to keep in mind versus 20 pays versus pay to 100s, because again, depending on how they're structured, if it's a policy dividend that's paying the premium rather than a pay to 100 that's offset and technically paid from the PUAs, it does make a difference in those withdrawals. So again, always whenever you're doing an IFA, really good to get some advanced tax consult, but we find this is a great way to kind of introduce the idea into the equation. Now, again, another kind of concept that we could drive off of the same sort of whole life plan here that you probably saw as I scrolled down to our sort of report components there would be something like a charitable gift. So again, I can click on the charitable gift. For this one, I'll still use that same whole life plan, although this could be done with a UL or a whole life. And again, feel free to add different report notes customized for your client if there's a specific goal in mind, like the charity of choice or things like that. But again, another great sort of graphic around if, yes, it's a whole life or universal life or permanent life insurance, but if you're presenting it as part of a concept like a charitable giving plan, sometimes the graphic or the flow of how this works is really, really beneficial to the conversation. So again, a little bit of information on how this can work, some of the different ways to structure it, and then again, that nice graphic of designate a new or existing policy to charity of your choice, receive the tax reduction on either those premiums, or again, it could be structured where the benefit is paid out and that is the charitable donation. So a couple different ways to structure tax for your clients. And again, on death, of course, the whole goal is that charitable gift planning, accelerating the amount of deposit that you would possibly have. Really, again, the whole purpose of life insurance is fund a liability at a lower cost. And again, it doesn't necessarily have to be a liability in this case. It could be part of something we want to fund as a future gift, but we want to do it at a much more effective way. Now, again, this is also good for your, maybe more affluent clients who perhaps could even come to you and say, I no longer have this need for the UL policy. I'm paying it every single year over and over, but I really don't have a need. Well, again, could be something where they need to reduce their tax liability by designating that insurance policy. So same sort of idea when setting up this kind of concept. Really, any kind of permanent whole life plan can be added. You can add in here, whatever product you'd like. And again, they can sort of see that, for the contribution, if we were thinking in pure tax dollar terms, a client may donate upwards, if they were a wealthy client, this would be maybe a little bit excessive, but let's just say if this client was going to designate $46,000 every single year to some form of charity, how much more we could boost that by assigning the policy. And again, there's a couple different ways that can be done. We can see that, for roughly $1 million, $920,000 of donations over time, if they had just given that every single year, the charity would benefit and get $920,000. But in this case, because we funded it with life insurance, and again, I'll actually go back here. I got to turn on my presentation charts, that we could actually show them how much of a bigger gift that we could give using life insurance by either designating, the policyholder or designating the charity as to be the proceeds of the policy. Again, you can see for that same sort of $920,000, rather than just have that as the net. Again, depending on what age you pass, there's a considerable amount more insurance. So when we talk about boosting the efficiency of that, it's a great concept to add in there. And now there's a nice little report note to, just structure some of the different ways to do it. Now, there are also options in there, hard to kind of capture all of them in the graphic. They all sort of, revolve on the same mechanics, but you can also purchase an insurance policy equivalent to your RRSP and then designate the charity of the beneficiary of your RRSP. And then on death, the charity issues a taxable receipt, which offers, kind of the tax impact there. And then the last option, of course, the wealth replacement insurance, donating a large asset or lump sum. So perhaps you have a Picasso painting or something like that. You could donate that to charity, which frees up a tax credit to you, which then you could buy a life insurance policy again. So kind of a reverse way of doing it, but perhaps you have another asset that's out there and it's kind of a way to create a refund for you in a sense, or a tax receipt of money that you would save, especially if you're the highest tax bracket, that could then fund the insurance policy. So sort of just a different way around doing that. But again, has some information on all those different ways. And again, a nice little graphic that just kind of describes some of the benefits. So after the concept piece, then you can back it up with some of the numbers of how you design this. And keep in mind, it doesn't have to be obviously a overfunded 20-pay whole life. This could be something like a min-funded UL, where again the tax receipt is just simply the the premium paid every single year. And again, the benefit is that we're able to give a much greater amount for that. The same sort of charitable gift. All right, now for our next concept, I'm actually going to create a brand new case. Let me just see if I have a test client in here. We'll go with Charlie Bob. And I'll hit continue. Now, Charlie Bob here is actually 43, age nearest 44. But again, I'm going to use that client override and make our client 1 year old. And this, of course, is the cascading life insurance concept or intergenerational wealth transfer. And what you can see, if I go back here to design a product for this, again, I can go into my Equitable Life here or any other different carrier that you'd like. This is, again, something that can be done with Universal Life as well if you wanted to, but I'll focus on the whole life here for the moment. And basically what I've designed here is $1 million for a 1 year old. Again, sometimes it's more around a contribution. A lot of times this is a great concept for grandparents as a gift that they can give for the children. It's certainly not a replacement necessarily for an RESP. I would always say that, and again, not financial advice, but usually the RESP is the first one. And then, if it's maybe maxed out on the contribution room, this is a fantastic way to maybe give an outside gift that, again, the cash value in the policy can be leveraged for education uses as kind of a tax-free loan. Or again, it may even just be, passing off the insurance to the children so that they always have something. A lot of times we think about sort of the price of the real estate market, and a lot of people are feeling priced out of it at the moment, and it's really, really hard to get that deposit. So they end up renting at a much higher price. Well, this, again, the cash value in the policy is something that could be used, to supplement maybe the down payment on a house. So again, a great concept that kills two birds with one stone in a lot of cases. Some people would say, children only really need term insurance and very little of it, but it is a different strategy that can be used, and I think is a great one. I personally do this with my kids, just so they have something, and again, the money is automatically going to account. It's something that's also behaviorally, sure, I could invest the difference, but oftentimes that gets blurred. So with basically what we do is we design, sort of whatever contribution you want for whatever age the child is. And again, same sort of process where we're going to view this spreadsheet and export it to Excel. In my case, I have, sort of $1 million of coverage, which works out nicely at about $10,630 per year. I'm going to grab this, come back to LDA here, and you can see I've overridden my client age to 1, but same sort of process. I'm going to bring in whichever, sort of cash value product I've dictated here. And I'm going to paste that spreadsheet in there and just say upload. And basically that's going to be the data portion of what I'm presenting. But of course, because we're talking about concepts, I want to back it up with something that describes the process a little bit more. So I'm going to go down here and I'm going to select that for my report components. So again, I'm just going to say cascading life insurance, which is, again, sort of that waterfall idea. So one generation passing it to the next. Or one parent passing it down to their child kind of thing. And the other thing I might do in cases where I'm dealing with someone who's 1 year old is that sometimes the graphs and charts that we're going to produce when you're looking out over 105 years become maybe a little bit overwhelming. There's a little bit too much data. So sometimes what I like to do is in the kind of the report components here, you can see there is a condensed chart button. And all I'm going to do is just set that to yes. And what it's going to do is actually reduce those bar charts that look out over 100 years of insurance benefit and condense them into 5-year increments just to make the visual a little bit more palatable. So that's just condensed charts. You can see when I go into my note here, I've got cascading life insurance, which is a private reserve for your children, grandchildren. So how does it work? Parent purchases an insurance policy on the child. You're using that cash value basically in the policy to build up as the asset that they can either leverage later or just simply take over. Parent or grandparent would own the policy, and then the child would be the contingent owner and primary beneficiary. And then again, just like all of our different whole life plans, the mechanics are the same. The cash value is always going to grow tax exempt, but it's just sort of structuring it around how we think about this sort of concept or strategy. So again, we purchase the life insurance, name the beneficiary, and money deposited grows tax exempt. So again, a couple benefits of this strategy, but when we look at sort of our value proposition, now we have some numbers to back it up. Again, we can see our 20 pay here and some of that cash value created. So again, these are the condensed charts. You can see there's lots of there's lots of bars along there. but the cash value in this case does grow quite significantly in relation to the premium. But even, if we had a child going to school at year 20 there, so we buy it for them when they're 1, and then by the time they're 20, again, there's $265,000 of cash in there that can be withdrawn. And again, for a deposit of $212. So good value, but again, that, if we think about this could be used as they mature. Maybe they get married and they need a down payment for the house. Well, in this policy, there's $504,000 of cash that could be leveraged as part of a down payment, which is so important these days. When we think about how we're going to fund some of these different houses purchases, could be university to an Ivy League school where perhaps you did contribute to the RESP, but it just simply wasn't enough just due to the nature of the school. So again, another great sort of concept that you can use inside of LDA, and again, pair it with a really, really great report note that has some of that visual graphic to go by it. All right, now for our last concept, I'm going to create a new case here, and I'm also going to work off Phil, who's going to be a 40-year-old male non-smoker, but again, any sort of age group would work for this kind of concept. I'll just back Phil to 40. Now with this one, we're going to focus on split dollar, and the way I like to illustrate split dollar is basically by starting off with our baseline. So I'm going to say plus CI and pick an insurance benefit. I'll just call it $200,000. And again, this is a great strategy for our key people in large companies. I'm going to select a term to 75 and just do the survey. Of course, you can do this with any sort of company out there. I already have the Equitable Life software up handy in my other tab, so I'm going to go down here and just find Equitable Life's Equiliving one and just add it to the case here. Now, what I want to do next is I actually want to bring in the product. So this one, again, what we're looking for in that survey, just to go back, is plans without riders. So we want just basically the baseline. I would recommend sticking with the same number, obviously, of covered illnesses. But what we're doing is basically we want to bring in the baseline so that we can add that plan with ROPD on top of it. And so basically to do that, on my second one, I'm going to add a manual whole life and design it so I can bring in those cash values. And basically while that's coming in, I'm just going to pop over here to Equitable Software, and I'll get rid of my Equimax, my whole life, and basically design here the same sort of quote. So I want $200,000, age 40, and again, what I want to do is I want to put my ROPD or ROPX on there, on surrender or expiration. So depending on how you're designing these, you can add multiple different riders on there. Obviously, that's going to increase the cost, but should there be no benefit, and again, we get that return of premium, that's where, again, that split dollar is going to come in. Now, what I'm going to do is I'm just going to grab the premium here. Before I do that, I was going to say my premium looked a little low. I've just got to specify what kind of coverage it is. And so I want level to age 75, just to make this apples to apples here. And so basically what I'm going to do is once I've got my plan design, I'm going to just quickly grab these columns here. So again, grab the first one, which is premium, and come over to LDA. Just a little bit different. We're using kind of our open-ended spreadsheet. So I'm going to put my premium in there. I'm going to come back and I'm going to say, what's my ROPC? So monthly premium. Here's our ROPD. So this is on death. And again, just when you're doing this, make sure you do go up just to the very top column, just to make sure you're grabbing all of those values. You can see I'll slide up here just a little bit and make sure I'm getting year 1. And so here's our ROPD that I put on there. I'll grab that, come back to LDA, put in our ROPD in the ROPD value there, and then just come back really quickly and get our ROPC. And that's cancellation or surrender. We're going to get that one, put that in there. And just our total insurance benefit. So again, sliding back here, grabbing critical illness, and we're just looking for that sum insured value. So again, just make sure you're at the top there, grab from the top all the way down, quickly copy it, come back here, and throw in our insurance benefit. We're going to upload that. All right, so once we have the products in there, one thing I recommend is actually editing this plan to just kind of describe what this is. And I'm I'm just going to say CI to 75 PC/D. So I'm just going to indicate, just for our purposes, makes it a little bit easier in the legend to kind of see those differences. Again, you might even change those names to be a little more obscured, like even, employer funded, employee funded. But basically what we want to do is we want to go down into our report concepts again, and what we're going to do is we're going to pick our split dollar arrangement here. And again, that's going to add a nice graphic note, and we can go ahead and generate the report. So you can see when I come down here, you can see what is a split dollar arrangement. It's got a nice little kind of description of the concept. And again, you can see, basically employee and the key person both enter an agreement to fund the policy. Generally, employer funds the base, the critical illness, and then the employee would fund that rider. Both payment parties make the payments, and if there is a critical illness claim, again, that business is protected from the key person. If there's not, again, which is what we're hoping for, there's still some benefit. The employee gets to keep that ROPD portion. And again, when we get into the numbers, we sort of compare that baseline versus the total. Again, we just get to see kind of the difference in what the clients are paying. And again, if you use the accumulation, you get to see basically the difference over all of those years. Essentially that difference becomes what they get back. Nice illustration of, again, we pay this out and you can see that they ROPC. If we start to cancel, we actually get the cash value back on it. So again, the employee would basically receive that green portion should it be canceled at that time, or, should they decide to retire or something like that and cancel that contract. And again, you can see, a really nice deposit difference of showing that basically that premium deposit difference versus the cancellation, this ROPC basically, is what they fund to get a return of premium equivalent to that. So again, there is some benefit to splitting that ownership. So again, nice little way to present it. Again, basically employer pays the base, employee pays that difference, and upon no critical illness claim could receive this back as cash value upon cancellation. And again, remember, there are some things, this is somewhat of a gray area. So again, definitely best to get, taxation counsel on this, because again, sometimes there is a taxable benefit to the employee for a strategy like this. Are really good for those companies with key person employees, where again, there's some benefit. And again, it can be even used as part of an executive compensation type strategy. So lots of opportunities there. Now, I actually think I have time to slip one more concept in there. So what I'm going to do is I'm actually going to go back into my managed cases here. I'm going to pull up our Phil Mickelson example that we had a term and a permanent product here. And you can see I've got Phil in here. And one of the other kind of things I wanted to bring in that was sort of neat here was whenever you have a permanent product, one of the other kind of concepts or strategies out there, or kind of common objections, might be a buy term invest the difference. So I just really want to quickly show, basically anytime you have a product with cash value, whether it's a permanent whole life or a universal life, we have a buy term invest the difference metric. And essentially to activate it, all you have to do is go into the edit plan button here of the product with the cash value. And at the bottom, you're going to see there is a buy term invest the difference plan. Now, any of the products that you've added in here will definitely show up under there. So it doesn't necessarily have to be a term 10. You could add a term 20 to the case, or term 30. You might even add a min funded UL compared to a whole life and say, basically the difference that you would invest in the whole life being a little bit more expensive than the baseline UL could be invested in an outside asset and run a buy term and invest the difference that way. Although generally speaking, the way that this sort of strategy works is people have the tendency to think, well, I'll buy the affordable term policy and the rest of that premium deposit difference, I'll just invest the difference. So in this one, you can see we've got $27,000 as our premium. Our initial premium here is $630. So presumably we would have a lot to invest. We'd have 26 and some change to basically invest year over year. And basically what the strategy looks at is, is that a viable option? And the thing I think people don't necessarily consider here is that because of all these renewals, the guaranteed renewals, that's, if we plan to keep buying term, again, we're either going to have to pay that, we'll assume we're healthy and pay a renewed cost at an increased age with new underwriting, or pay those guaranteed renewals. So even when you are adding this term plan, remember that when you're doing that term survey, and I'll just quickly pull up here a T10. You can always add it to the case as a reissue as well, and that will model out as if they're repurchasing at each age interval. So Phil here is age 40. The reissue would say, okay, we'll add it at 630, but then at age 50, we'll look at what buying new insurance would cost and keep doing that over and over. So again, it does assume that risk, but if you wanted to model it with a little bit more conservative number, saying that maybe they were younger and going to be able to repurchase insurance, you could certainly do that. So again, basically this just forms the baseline data. Depending on how aggressive you want to be, you can certainly model that with a reissue as well when doing by term. But essentially all you'll have to do is go into the edit plan, select the term that's the difference from, and basically what we're going to do is we're going to take the premium difference between this whole life and whatever product you selected and run that same sort of accumulator that we did before. Now again, all I want to do is make sure that I have my by term invest the difference chart on there. I'm going to get rid of a couple of these other charts because they're not necessarily in play for this, and I'm going to go ahead and generate my report. Now, as you'll see, when we go down into the sort of our concept here and kind of our presentation summary, at the very bottom here we're going to see a by term invest the difference here, and basically in green here we're seeing the cash value of the whole life, and in blue we're seeing that alternate investment or what it would accumulate to. So again, we can see certainly for the first 10 years, because of that really affordable term 10, we have a lot of difference to invest, and we're outdoing and we're actually exceeding that of the whole life plan. But as those renewals start to come, and again, it doesn't matter if we're using the guaranteed, that will exaggerate it a little bit more, but even if we're using a reissue, those prices for the renewed term insurance are going to jump up there. And you can see at some point those returns or those guaranteed renewals basically take away from the returns that we've accumulated. So we'd actually have to choose, are we going to lapse the insurance at that point where it's starting to be detrimental to pay those premiums. And again, that leaves sort of another deficit where of course you can bring in that sort of coverage amount. So if you were, if you did go into the account settings, you could choose to lapse that term policy at a certain year, and that would be reflected in there as well. But the big point is that yes, you may be able to invest the difference and earn income on it, but because of the nature of insurance, that as the older we get, these renewals for our term products become prohibitively expensive. The amount that we have to invest the difference often becomes a negative, as you can see, and takes away from that. So again, great kind of report component to use where you can essentially take the difference in the two plans there and run that same accumulator to say, how much would we actually earn factoring in those renewals that we'll have to pay. So that really brings us to the end of the webinar. As I say, if you do have questions on this, feel free to reach out to the live chat. And again, if you are looking at this for the first time and want to try out one of these concepts, absolutely navigate to the lifedesignanalysis.com, sign up free. You get the 30-day free trial. If you have any questions about these as an active subscriber, get in touch. But thank you so much. Look forward to you on the next webinar. Take care.